Hey guys, you're welcome to the channel. It's Arab the Plug again, and this is another technical analysis video where I'll be talking about the double top and the double bottom chart pattern. And in this video, I'll be talking about how you can use double top and double bottom to get accurate trading decisions for your trade. This is not actually going to be too long. It's going to be like short, straight to the point, and concise. So make sure you stick to the end. And also, if you like content like this, ensure you subscribe to the channel and also hit the like button. So let's get right into it. Right, so double top and double bottom is actually one of the most popular chart patterns that form on the charts, and that a lot of traders all across the world, no matter what kind of strategy, what kind of trading strategy you use, actually recognize. And this pattern is one of the patterns that forms the most in the chart, and also it is more like a reversal pattern. So double top pattern and double bottom pattern are reversal patterns that form on the chart. So double top, we actually call it double top pattern or M pattern, and or the double bottom, we call it double bottom pattern or W pattern. And the reason why these patterns are named so will be explained during the course of explaining this video. So let's look at this particular picture. You would see that in this particular diagram I have on my chart, this looks like a W, which is like the double bottom pattern, and this pretty much looks like M, which is like a double top pattern. And the significance of this pattern is that in this double bottom pattern, the market is in a downtrend. The double bottom pattern shows the market reversal from a downtrend to an uptrend, while the double top shows the reversal of the market, or the change in the direction of the market from an uptrend to a downtrend. So in the double bottom, what we have is that the market has been in a downtrend, then we make a low here, the market reversed, then the market was trying to like make another low, which is going to like make the continuation of the bearish trend, but the market got stuck at this same place where it reversed the previous time, showing us that the market, the bearish or the bears are weak, and the people pushing the market downwards are actually weak, and they could not continue pushing the market downwards. And now the bulls took power, or they took control of the market, and they start pushing the market upwards. So that is what the double bottom simply signifies. So we have two bottoms, which is like the first bottom, which is bottom one. We have the second bottom, which is like the bottom two, and we have something we call the neckline. The neckline is more like, okay, the point whereby once the price breaks through it, then we have a confirmation of the fact that the price has fully moved from a previous downtrend to a new trend in the market, which is like the uptrend. And also looking at the double top pattern, we see that the market is clearly in an uptrend. The market is going up, then reversed, tried to go up again, but it got stuck and it formed an M pattern, like an equal high, which is like, okay, the market stopped here, came down, went up again, and could not pass this place, stopped at the place again, and started dropping down. So once it drops to this point, we draw a line here and we call it the neckline. So after the break of the neckline, we'll take the trade. So in this video, I'll go into the chart and show you the double top and double bottom patterns from real life examples on the chart. Then I'll talk about the strategies I use to trade them, and how to trade them, to use them to get really accurate trading decisions. So in the double top and double bottom, we actually have three major components. The first component is the first bottom. For a double bottom, we have the first bottom and the second bottom. And then we have the neckline. This is the neckline. The neckline is an area that serves as a resistance in the double bottom, and it also serves as a support in the double top. And once this neckline is broken, then we have a confirmation of the double top or the double bottom. So let's get right into our chart and look at potential double top and double bottom examples that we can trade. So this is Euro USD chart daily time frame, and you can see, if you look at this chart clearly, you will see that what we have here is a clear double top rather. The market has been in a bullish direction, and you can see the market has been making highs and lows, higher highs, higher low, higher highs, higher low. Then the market made a higher high at this point, right? Came back here to make a low. Then instead of making a higher high, the market was unable to make a higher high at this point and got stuck at almost the same level where it made the previous high. When it got stuck here, it started coming down, came to this area that served as a support, and that is what we call the neckline. And it broke the neckline a little bit, reversed a little bit, and started dropping. And what happened after this drop? We see that the market had a really massive downtrend that lasted for a very long time. And if anyone could catch this movement from around this place, right, this was like September 2021, and the market was in the downtrend for a whole almost a year till like 2022. This is the downtrend that lasted for a whole year. So imagine you caught the downtrend right from this place till this place, then that is a massive one for you. So the bone of contention is that whenever you see a double top and double bottom pattern, especially on a higher time frame, when they form on a higher time frame, they tell you the market is really about to reverse, and the reversal is usually always like a very massive one. So let's look for a double bottom example and see. Then after that, we'll talk about how to trade the double top and double bottom. All right, guys, this is the gold chart. You know, gold is what you trade in forex. It's a commodity we trade in forex, and this is a gold chart on a 4-hour time frame. And we'll see that previously this market was in a downtrend. We have series of lower highs and lower lows, lower highs. Market made a lower low, reversed a little bit, made something like equal low, reversed, made a lower low, reversed here and made an equal low. Then the market came up here, and this is our neckline. So what happened simply in this market is that the market has been in a downtrend for a very long time. Then the market made a low here, reversed, tried to make another low, but it got stuck at this point and it started reversing. This particular place is our first bottom. This is bottom 1 and this is bottom 2. You actually can call this a triple bottom 2, but the reason why I'm not calling it triple bottom is that when the market reversed at this point, the reversal was just a little bit and it didn't like go up to this place. So I call it a double bottom because the obvious stages where the reversal occurred was from this first bottom and this second bottom. So when the market came down here, it tried to go down, got stuck here, reversed, came again and got stuck. So this is bottom 1 and this is bottom 2. That is why we call it a double bottom, and this point which serves as a support for this bottom is what we call the neckline. So in double bottom or double top, you always must have at least or majorly 2 bottoms for double bottom and majorly 2 tops for double top. And one of the things you have to know is that when we have this double bottom, it might happen that one bottom will be a little bit lower than the other, but the distance must not be too much, because if peradventure in this market, let's say the market has come down and started coming down to this place, then we say we can't call that a double bottom because the market has already created a lower low with that. If you understand the rules of market structure, you know that is a lower low. But in this case, the market did not do that. The market reversed and came to this neckline. So that is simple and straightforward. So that is how to identify double top and double bottom. Let's go into one more chart and see one more example of double top and double bottom. This is a chart of Euro CHF on a 4-hour time frame, and you can see right on this chart we have a very clear double bottom. And like I said in the previous session when I was talking about the other double bottom, you will see that this double bottom is not actually like the perfect one because the bottom are not exactly on the same line. But the concept of double bottom is simple and straightforward. The concept is the market tried to give us a low, reverse, and try to break that low, but it could not. So this double bottom is actually valid and it is also perfect. So like I said, what happened, the market came to this neckline, right? Here's the neckline, broke the neckline, and the market reversed in price, and it was the market turned into an uptrend, and the uptrend was a really massive move. So it's very important for you as a trader to be able to like identify double tops and double bottom and also catch the movement and learn how to trade them. So now let's get right into how to trade the double top and double bottom. How do you trade double top and double bottom? So going back to our Euro USD chart on a daily time frame, let me just get rid of all these lines. So on the Euro USD daily time frame, what we see is that we have a clear double top pattern that formed when the market tried to go up here, reversed, tried to go up again, and came back to this neckline. So what we trade in double top and double bottom is actually the break of the neckline. So once the neckline breaks, we take a trade. Well, how do you take a trade? I actually have like 3 different strategies I use to take the trade on double top and double bottom. And let's talk about this strategy. The first one is that neckline break. When the neckline break, I take the trade. But how do I take the trade? The first one is aggressive entry, right? Whenever the neckline breaks right here, whenever the neckline breaks right here, I take an aggressive sell in the market. So this is the point where the neckline was broken. It got broken here, right? But it reversed. So if you are taking an aggressive short entry here, so it is one of the things I usually tell traders. If you are taking an aggressive short entry here, you probably would have put your stop loss somewhere around here, even though I don't take my entries on the higher time frame. And your target would be somewhere around here, which is like I usually make my trade at least 1:3, and I look at previous areas of value to take my entries, my target. So if you look at this market, you would see that the next area of value you will get on this chart is somewhere around here. So that's probably going to be my major target before I look into the market again and see if the trend is going to continue. So this is a perfect 1:2.9 trade, which is almost 1:3 trade. But you will see that if you had taken an aggressive entry right here, because majority of traders take aggressive entries whenever they see patterns like this form. If you are taking aggressive entries on this chart, you will see that there is high probability of the markets hitting your stop loss before moving in your direct entry, moving into your direction. So that is why most of the time I actually don't take aggressive entry, except that the only condition where I take direct aggressive entry is that when the neckline breaks, it breaks with a very big momentum candle. You would see candles like this. If you see this bearish candle that the arrow is currently pointing, and all the candles that follow, you see that it is a really aggressive entry. But when you see that when the neckline broke here, you see that these candles are very short candles. This bearish candle, then this bearish candle, then this bullish candle are actually very short candles that are not aggressive, telling you that the sellers are not actually fully in control at the moment. But you see the market reversed, came back, and at this point you see that aggression in the sellers. You see the long wicks and the aggression in the sellers, and that is actually when I want to be taking my entry. So aggressive entry is actually valid if the trend line breaks if the neckline rather breaks with aggression. If the red candle that breaks the neckline comes with a very full candle that is very long and that is aggressive. So that is the first way I trade double top and double bottom. The second strategy I use is what we call the pullback entry strategy. So the neckline break and the pullback entry. So in this market, you see that when the neckline broke at this particular point, the market reversed and then come back here. So that is what we call, then when the market came back here, it reversed a little bit, which is like a pullback, then I enter. That is what we call the pullback entry. And the logic behind this is that whenever trend line breaks, whenever a neckline breaks in the double top or double bottom, and you see that this neckline didn't break with an aggressive candle, right? When you see that the neckline didn't break with an aggressive candle, all you have to do is just wait. All you have to do is wait for the market to reverse, then come back and break the neckline once again. So once it breaks the neckline once again, you anticipate some really candles that can actually give you a clue of what's going to happen in the market. And if you look at this chart, you will see that we actually have candles that show that, okay, the neckline has broken with a reasonably momentum candle. Then we have the candles that follow it, which is like a 50-50 candle showing you that the market has not decided. Another candle telling you the market has actually not decided. Then you see this bearish candle followed by a bullish candle that gives you a net that gives you a wick. So if you understand candlestick pattern, you will see that when you have candles, multiple candles that give you a weak rejection, it's telling you that the market is about to break to the downside. So now, after this, then we have a pullback. Like this is the pullback. This is what I mean by pullback. When the market broke again here, we have a pullback towards the neckline and you enter. This is something that happens a lot in the market, and it happens a lot in double top and double bottom, and this is exactly when it should be entering. So my strategy is that when the neckline breaks, you expect a pullback into the neckline, and this place you will expect a pullback to the neckline, but a pullback didn't happen to the neckline. A pullback happened back into the area of the double top and double bottom, right? The area of the double top, you can't enter here because the market is telling you maybe this is just a fake out and it's not a double top. But when the market came back again and break the neckline, you are sure that, okay, fine, this is a double top and it's like a real neckline break. Then you anticipate a little pullback into the area of the neckline and you enter. And this is like the perfect entry for you if you're entering this trade. And you see, if you actually enter here, this is actually going to be your stop loss area, because this is an area of resistance or an area of value on your chart where the market has always come and respect several times, and you just put your stop loss somewhere around it, not exactly by putting it at that exact point. Then you have your target at the next area of value, which is the first target, and okay, the pullback entry around here. Then you have the target at the area of value. So this is going to give you at least 1:3 trade, which is like the perfect trade for you as a trader. So that is one of the strategies I used to trade double top and double bottom. Looking at this gold chart for the double bottom on the 4-hour time frame, this example that I just gave you a few minutes ago, you would see that at this point the neckline broke, and when the neckline broke, even though it broke with a really aggressive candle, it still reversed and come back. And that's why it is very important that you know that this neckline is important and the strategy you use is important. And that is why I will talk about another strategy, which is like the double top and double bottom at a key level, because this particular area is actually a key level on your chart that the market has respected several times in the past. So if the top or double bottom happens at a key level, especially at an area of support, then you expect that if the neckline comes at a previous area of support in your chart, if you look at this area, you will see that this area can be drawn back to this particular point in the market. And you will see that if you still move the market up to this point, you will see this has also served as a neckline before. So this is a key level. This is an area that has been respected on the chart several times again and again. So whenever the neckline happens at an area of support that has tested multiple times in the past, you expect that even if the neckline breaks, the market comes back and tests the neckline again. So that is what actually happened in this gold example. And what happened was that when the market broke this particular neckline, it came back to retest it as an area of support that had been tested in the past. So in this particular example, you as an experienced trader, you will not actually enter here. You wait for the market to test this area again and take your entry here. And once you take your entry here, you are actually going to get like one of the most accurate trading decisions that you ever make. And you see, this is the first level target because this is the next major area of value. Then this is another level target, and you can simply place your stop loss here. This is more like 1:7 risk to reward trade. Even though for me my first target will be here, it's like 1:4. Then the second target would be here, which will be my final target for a trade like this. So this is actually how to trade the double top and double bottom, and you can actually see that there is another double bottom right here, right? And this is like a neckline. This is like the neckline for this double bottom, which is like perfect, and the market broke the neckline, and what we have again is a massive bullish trend. So this is actually an ultimate guide to trading double top and double bottom. And if you got value from this, ensure you subscribe to the channel, hit the like button, and I'll see you in the next one.